Hello, good evening. How are you? I hope you guys are doing well. Okay, so let's start with the third session of our financial reporting. And today we are going to tackle with the section B question first. From the previous topic yesterday that we covered, and then we'll go towards as far as the section C type questions today. So let's start without wasting any time. Here we go. The following scenario relates to question 306 to 310. So we have this thing over here that on 1st September 2023, Ledlock Factored sold 2 million of the trade receivable to the Fenneys. Ledlock received an immediate payment of 1.8 million under the factoring agreement. Any receivables not collected after the 4 months will be sold back to Ledlock. Then on 1st October 2022, Ledlock sold some maturing inventory which had a cost of 4.5 million to a bank for its fair value of 5 million. Under the terms of the sales agreement, Ledlock has the option to repurchase the inventory after a period of 10 years at a price of 7.4 million. And then at this date, the fair value of the inventory is expected to be 11 million, and the repurchase price reflects an equivalent annual interest rate of 4%. Then the third point is the Ledlock issued 10 million convertible loan notes on 1st October 2022 that carry a normal coupon interest rate of 5% per annum and are redeemable on 1st October 2025. Okay. A similar loan note without the conversion option would have required the Ledlock to pay an interest at the rate of 8%. So relevant discount rates at the end of the year, 5 and 8%. Okay. Now the first question is 306. Which of the following is correct regarding the Ledlock's factoring of trade receivables for the year ended 30th September 2023? Now, as far as the factoring of the receivables is concerned, if I, talk about it over here, this is simple that we have sold the receivables over here for 2 million. We have received an immediate payment of 1.8 million. 0.2 million has not been received. So that is kind of sort of the factoring fee over here. Secondly, if there's a condition now, the receivables not collected after 4 months are going to be bought back or are going to be sold back to Ledlock. So technically speaking, the risks and the rewards have not been transferred over here. So I cannot say that this is without recourse. This is the factoring of the receivables with recourse, where the bad debts are the responsibilities of the selling company. In this case, this is the Ledlock over here. So in this case, we cannot de-recognize the receivables over here, right? We cannot de-recognize the receivables over here because the bad debts are still the responsibility of the Ledlock. So the amount which has been received over here is going to be, catered as a sort of short-term loan over here, right? So if we look over here, as far as the requirement is concerned, that what is correct regarding the Ledlock's factoring. So 200,000 should be recorded as an administrative expense for the disposal of the receivables. No. The receivables should be removed. No. This represents a without. No. This is with recourse, not without recourse. So the correct option left is going to be the option D over here. That is, the receipt of 1.8 million should be treated as a loan over here. So yes, this is a loan. This is going to be a loan over here. So we can say this is a kind of sort of a loan over here, because any receivable which is not going to give away the money, Ledlock will have to repay the money for that as well, right? So this is going to be the option D over here. Then what amount should be recorded in equity in respect of the convertible loan issued by the Ledlock? So this is the convertible loan, and it's asking that what amount is to be recorded in the equity. So we have learned about this one as well, that say in case if a company issues the convertible loan stock, so technically speaking, we have to split it between the equity and the debt portion. And when we do so, while splitting it into the equity and the debt portion, we are going to use the discount rate for the sake of the discounting over here without the conversion option, and then we'll simply have the present value over here. And the present value that we calculate and the carrying value that we have over here, the difference between the two is basically going to be the equity option. So we are going to have the number of years over here, then we have the cash flows over here, then we have the discount rate over here, and then we have the present value over here. So we have issued the loan note on 1st October 20x2. The year end, where is my year end? Okay, I don't have the year end, but anyhow, yeah, that's going to be 30th September, by the way. What is my current year? 30th September 23. Okay, I got it. First year end is 30th September 23. So these are redeemable on X5 over here. So I am going to have 20x3, 20x4, and then 20x5 over here. Okay. So I am going to cut these base over here. Cash flows, I am going to get 10 million, 5% over here. I'm going to have the figures in the thousands. So 5% is going to be, okay, next thing which I have to do is, okay, so 500,000 is going to be here. 500,000 is going to be over here as well. And then over here, 500 plus 10 million is going to be over here. Discount rate 8%. This is going to be 0.93, 0.86, 0.79. And then the present values are 500 into this and so on this. So we get total present value, and that is going to be 9190 over here. So 9190 is the total present value over here, whereas the total carrying value have is 10,000 over here. So automatically the equity is going to be the balancing figure over here. That's going to be 10,000 minus this. So that's going to be 10,000 minus this 810. So this one. So 810 is going to be the answer over here, right? Okay. Then we have this 308 over here. Now, with as far as the 308 is concerned, this is going to be straightforward again. Which two of the following items should be recorded in lead loss financial statements for the year ended 30th September in respect of the maturing inventory over here is concerned? As far as the maturing inventory is concerned, what do we have to look over here for? If we look at the arrangement of, this explicitly as far as the maturing inventory is concerned, over here, this one. The inventory's cost is 4.5 million. It has been sold at its fair value of 5 million over here, right? It has been sold at its value of 5 million. So under the terms of the sale agreement, Ledlaw has the option to repurchase after a period of 10 years at a point or at an amount of 7.4 million over here, right? So after 10 years, this is something which is going to be bought back at this price. Done. So technically speaking, if we talk about the price is already decided over here, right? So, if we talk about, or if we try to look at the arrangement over here, if we look at the arrangement over here, we have pledged our inventory with the bank or the financial institution, and we have gotten a loan over here, right? So we are going to have this inventory back no matter what. We still have the control of the inventory with us as well. So we cannot record the sale over here, right? So therefore, we have to record the loan along with the difference that we have over here as an interest expense over here, right? So if I go, which two of the following is concerned, 200,000 is the finance cost. So this is 4.5 million. Fair value is 5 million. Equivalent interest rate is going to be 4 over here. So technically speaking, fair value is the 5 million over here, right? So 5 million's 4% is going to be 200,000. So 200,000 is going to be the finance cost over here. 50,000 release of deferred. No, we don't have any deferred income over here. This is a loan. This is not a deferred income. 5 million of the revenue. No, we cannot record the revenue over here because this is a loan. It's not a sale. And then the option D is 5.2 million for the loan over here. Now, if we look over here, yes, 5 million the loan, and then the amount that we have to pay at the end of the day, that's 200,000. So 5.2 million is going to be there. So 5.2 million is the loan over here. So this option is correct as well. So the relevant options that we have to take over here are going to be A and D over here. Okay, then we have this 309. Which of the following statements regarding the convertible loan notes is not true over here? Not true over here. The convertible loan notes will affect the gearing due to the liability component being different to the equity. The convertible loan notes will affect the gearing due to the liability component being different to the equity. Yes, yes, yes. If you look at over this is true over here. I mean, obviously you will have the difference in the gearing now. The equity amount will remain fixed until the date of conversion. Absolutely right. The equity remains fixed. We don't do anything. We just write it as a separate item as the equity option, but we don't do anything else. The liability at 30th September 20x5 will be 10 million. 30th September 20x5 at the redemption value is 10 million. Yes. True. 5% of the interest will be charged to the statement of profit and loss as a finance cost. Not 5%. Effective interest rate is 8%. So 8% is going to be charged to the income statement. 8% of the interest is going to be charged. So this statement is wrong. So we are going to have this as the option because we have to identify that which of the following is not true. Done? Okay. Then applying the principle of split accounting to convertible loan stock is important to satisfy which of the following qualitative characteristics? Splitting, faithful presentation. This is the faithful representation over here that we do normally over here. Okay. This is the faithful representation over here. Done? Okay. Now, moving ahead from here, let's just go into the question number 2 over here. Let me just zoom it up. Here we go. Okay, this is again related to the convertible loan stocks. Here we go. Okay. The following trial balance extracts relates to the Howard at 30th September 2025. Convertible loan stock liability component is 28,508. 5% loan notes 10,000. Equity instruments 6,000. The following notes are relevant. Convertible loan notes. Convertible loan notes are the 8%, 30 million convertible loan notes issued on 1st October 2024 at par. Equivalent loan note without the conversion option has an interest rate of 10%. Howard Finance Director correctly split the instrument into its equity and liability components at 1st October 2024, but has done nothing else over here. Okay. Nothing else has been done. Okay. Now, second one is 5% loan notes were issued at par of 10 million, but Howard incurred 400,000 the issue cost. So the loan notes have an effective rate of 8%. Okay. Issue cost is going to be deducted, and then we are going to take up the interest rate. The equity investments relate to 1 million shares in Kapoor, an unrelated entity. During the year, Kapoor paid dividend of 10 cents per share. Then on 30th September, the fair value of each Kapoor share was 7 over here. Number 1. Which of the following items or which of the items included in the trial balance extract will be classified as financial instruments? All three are convertible loans or 5% loan notes, investments. All three are the financial instruments over here. So option D. Option A, all three of them. All three of them are going to be the financial instruments over here. Then, what should be the value of the liability element of the convertible loan note to be at 30th September 2025? Convertible loan note. This convertible loan note. So it's asking the amount liability element that has to be there at 30th September 2025. It's issued on 20x4. So on 20x5, the number of years, I have liability at start, I have interest, I have total, I have repayment, then I have liability at year end. So liability at start, convertible loan stock. This is showing 28,508. Interest rate is going to be the effective interest rate. Without conversion is the rate of 10%. So my effective interest rate is 10%. So the total is going to be this. Repayment is going to be 30 million, 8%. And then the liability at the year end is going to be this one over here, 29,959. So this is going to be the answer over here. So here we go. 28,959. Okay. 313. What finance cost should be shown in the statement of profit and loss in respect of the loan notes? Finance cost in respect of the loan notes over here. So these are the loan notes. These are the loan notes over here. This one. So basically we have total value 10 million less issue cost. Issue cost is what? 400,000. So initial value is gonna be 9,600 over here. And then we are going to have the interest over here. And the interest is 8% effective interest. So this into 8% is going to be 768 over here, right? So the question asked the finance cost over here. This 768 is going to be the total over here. Okay, then I have this 314 over here. What income should be recorded in the statement of profit and loss in relation to the equity investments over here? What income should be recorded in the statement of profit and loss in respect or in relation to as far as the equity investment is concerned? This is the equity investment over here, right? So it's asking for the income that can be recorded, right? So I have 1 million shares. I got the dividend of 10 cents per share, right? So technically speaking, this 1 million share, 10 cents is gonna be 100 over here. So that's gonna be what? And okay, unrelated entity. The fair value of each share was 7 over here. So this is 1 million, and this is what I'm gonna have over here. This is what I'm gonna have over here. So it's asking that what income should be recorded in the statement of profit and loss in respect to the equity investments. Income. I have 1 million shares. Okay. Look at this point as well. Equity investments, they are recorded at 6 million. Now the value is at 7 million. So gain on investment, this is income that I have to record as well, because they are standing at 6 million. So value was 6 per share, because 6 million divided by 1 million is going to be the rate at the start, but that was 6 over here, right? Now the rate at the year end is 7. So gain on investment is by 1 million as well, right? So 1 million is going to be my gain on investment as well over here, right? So that's going to be 1 million plus 100 at 1100 over here. Okay. That's going to be my answer over here, right? Then I have 315. Howard is uncertain of how to treat professional fee over here. For which of the following investment should the professional fee be capitalized as a part of the initial value of the asset? Fair value through other comprehensive income, it's capitalized. Fair value through profit and loss, it's not capitalized. Amortized cost investments, yes, we do capitalize, right? So this is what we have over here. Okay, now moving ahead from here, let's move forward. We have this keystone question. This is related to now the section C, where we have to make a statement of profit and loss, then a statement of financial position. Statement of changes in equity is not required. So I'm going to start this question in 2 to 3 minutes only, right? In 2 3 minutes, we are going to start. Okay, so let's start now. Now, listen to the instructions very carefully over here. Whenever you're going to go into the section C, you will find two questions over there. One question is going to be 99%, I'm sure that's going to be of the consolidation, and the other question is going to be from the ratios, cash flows, or the final accounts. Now, the best thing is you are going to straight away look at the question, and rather than reading the question, you are going to straight away look at the requirement, that what the requirement of the question is, right? Rather than wasting the time on reading that what is written in the question, all you have to do is straight away go and look at the requirement of the question that you have, right? Now, if I look over here, the requirement over here is that you have to prepare the statement of profit and loss and the other comprehensive income for the keystone, and then you have to prepare a statement of financial position for the keystone as well, right? So one is the statement of profit and loss over here, and the other one is the financial position over here that you have to prepare. Done. So what we are going to do over here now is, first thing first, we are going to create a format over here first. Okay, we will create a format over here first, and then we will move forward towards as far as solving and putting in as far as the everything else is concerned, right? Okay, now let me go and make up the format over here. Now what you have to do is, whenever you get the question, straight away go and create a format. Here we go. I'm gonna box it up for the statement of comprehensive income, and then on the parallel side, I will go and no, this is enough over here, and this is going to be a bit longer till line number 35. It's okay, and this is going to be for the financial position. So we have the question keystone. Okay, look. This format is something that you will have to prepare in every question, okay? So keystone, statement of comprehensive income for the year ended 30th September 2021. Here we go. I'm going to stretch it out, put in the currency signs. Now I am going to write revenue, cost of sales, gross profit, distribution cost, reference working one, administrative expenses, reference working one. I'm going to leave one line, and then I am going to write operating profit. Then leave one line and write finance cost. Leave two lines and then write profit before tax. Then you have the taxation expense, and then you have the net profit for the year. And then I am going to write other comprehensive income for the year, or other comprehensive income, let's just say, leave 2-3 lines and then write total comprehensive income for the year. And our question is gonna end over here, and then on the net profit we will have this double lines as well. Then I'm gonna go over here, keystone, statement of financial position as at 30th September 20 X1. I'm gonna put up the currency signs over here. I have assets, I have non-current assets. I'm going to leave around 4 lines, 1, 2, 3, 4. Then I am going to write current assets, inventory, receivables, leave 1 line, and then write total assets, leave 1 line, and then write equity and liabilities. We have share capital, share premium, retained earnings, revaluation reserve. Then we have non-current liabilities. Leave 2 lines and then write current liabilities. Leave 3, 4 lines and then write total equity and liabilities. Our question is going to end over here. Then for the total assets as well. Now a bit of cosmetic formatting. I am going to underline this current liability, non-current, equity, current, non-current, and assets over here. Then I'm going to write workings. Working 1 is going to be cost of sales. I'm going to write this as distribution cost. Then admin expense. Then I'm going to put up the currency signs. I'm going to leave like around 8, 9 lines, and then I'm going to write working 2. Then highlight these as well. I mean, you have to highlight the working numbers over here, okay? They are going to be helpful for you. Done? Okay. Now, yeah, this is going to be the working 2 over here. Now, after this, when you have done this, whole formats over here, straight away go to the following notes are relevant, right? We're going to go into the relevant notes over here, and then we are going to solve these notes first, and then we are going to go and we are going to solve these one by one, and eventually when we are going to get done with these, automatically the whole question is going to be solved. Number 1, during the year, Keystone manufactured an item of plant for its own use. The direct materials and labor were 3 million and 4 million respectively. Production overheads are 75% of the direct labor cost, and Keystone determines the final selling price for goods by adding a markup on total cost of 40%. Okay. These manufacturing costs are included in the relevant expense items in the trial balance. So if I go, okay, these are the items over here: material, production labor, factory overheads. Okay. Then the plant was completed and put into immediate use on 1st April. And then all the plant and equipment is depreciated at 20% per annum using the reducing balance method with time apportionment in the year of acquisition. Okay. Now we have self-constructed this plant and we straight away brought it into the immediate use as well. So technically speaking, this is IS 16 over here. I mean, we are allowed to construct our asset as well. So we are simply going to account it for over here, and then we are going to capitalize this value as well, right? So I'm going to go over here in working 2. I'm going to say this is self-constructed asset over here. So I am going to have the material, I am going to have the labor, then I have the other overhead cost over here as well. As far as for the material is concerned, it said 3 million for the material, 4 million for the labor, and 75% of the labor cost of labor cost. So that's going to be 4,000 into 75 is 3,000. So total is going to be 10 million over here. Okay. Now, this 10 million has to be depreciated over here. So plant was brought into immediate 2001st April. Our year end is 30th September. So April, May, June, July, August, September, 6 months, right? 6 months have gone by. So 6 months depreciation charge is what that we have to take up over here. And it's depreciated at 20% per annum. Okay. So that's going to be 20% into 6 by 12. So that's going to be 1,000 over here. So carrying value at year end is 9,000 over here, right? Okay. Now moving ahead from here. I have to take up this depreciation charge over here. I'm just going to write the balance given, and then I'm going to write depreciation self-constructed asset working to depreciation is 1,000. So I will write this 1,000 over here. I'm going to go into the non-current assets. I will write my self-constructed plant working to with 9,000 over here, right? And if I talk about this has been included in this item now, right? So technically this material and everything, it has to be charged towards as far as the cost of sales is concerned. So I will write this material, production, and factory overhead over here. Material for labor, and then the overhead cost, and all of these balances are given to me. So I'm going to write 64,124. And then I have this 80,000 over here. Then I'm going to write plant capitalized working to, and I will minus this 10,000 from here. This is the plant capitalization, so I have to minus up this from here, right? So this is what I am going to have over here. Done. Now, the directors decide to revalue the property in line with the recent increase in the market value. So in 1st October 2020, an independent surveyor valued the property at 48 million, which the directors have accepted. The property was being amortized over an original life of 20 years, which has not changed. Keystone does not make a transfer to the retained earnings in respect of the excess amortization. The revaluation will create a deferred tax liability over here as well. Okay. So, working 3. This is going to be related to the property. So we have the cost over here. If we go on the trial balance and if we look, property 50 million, accumulated depreciation is 10 million over here. So we are going to have this 50 less accumulated depreciation 10 million. So carrying value at start is going to be 40,000 over here. Okay, now we are going to have this, carrying value at the start of the year. And the property has been revalued at the start of the year as well. Now the property value is 48 million, right? So I am going to write fair value of property 48 million, right over here. So we are going to have the amortization charge for the year over here. And if I go original life, 20 years has not changed, right? So if 20 years life has not changed, so we have to see that what is the remaining life over here for as far as the property is concerned over here, right? I mean, because I will have to calculate the life over here and how much has gone by over here as well. Now, if I see this is saying that 20 years is the original life, but I cannot see anywhere as far as what life has gone by, because this is accumulated depreciation is just given to me at 10 million over here, but I can't see at what time basically I bought the property, right? So how to determine that if the total life is 20 years, then how many years have gone by? Now for this, I'm going to give you a tip over here, how to determine the expired life of property over here. Total amortization is 10 million. Then amortization per year is, that's technically 50,000 divided by 20 years, and that's gonna be 2,500. So divide the total amortization with 1 year amortization. That's gonna be 10,000 by 2,500. That's gonna be 4 years. So 4 years are gone. Remaining life is 20 years minus 4 years, and that is 16 years over here. So over here, the amortization charge, 48,000 by 16 is going to be 3,000 over here, right? So the carrying value at year end is going to be 45 million over here. And if we look over here for this, we are going to debit the property. This is 40 million, this is 48 now, so 8,000 over here. Credit revaluation reserve with 8,000 over here. So we have to record this amount, this revaluation reserve as well, right? So this is something which we have to record at the moment over here. So I'm going to go up, property, working 3 with a carrying value of 45 million. I'm going to go over here, amortization, property, working 3,000 over here. That's going to be added up into the cost of sales. And then I have this revaluation reserve. So I'm going to have this revaluation reserve over here. And if I look, I have the after tax retained earnings. So I can't see anywhere as far as any revaluation reserve is concerned, right? So I can simply assume that this is gonna be what? 8,000 over here. So right in front of it, I'm gonna write in bracket 8,000, and I'm gonna leave it over here as it is because I have to apply minus the deferred tax. I'm writing this minus DT over here so that after doing or completing the whole workings, when I am putting up the figures over here, as soon as I read this, I would know that, okay, I need to do the deferred tax adjustment over here. Why am I not doing the deferred tax adjustment over here? Because when we are going to get the whole information about the tax, then we will do it, okay? So we have to follow up a proper sequence over here. Then this is the working three over here. Now moving ahead, let's see what else do we have. Now, all depreciation and amortization is charged to cost of sales. We are already doing that. No depreciation or amortization has been charged on any of the non-current assets for the year ended 30th September 2021. Now go up. This is the property plant. We have this plant and equipment over here at cost as well. And this plant and equipment, this has to be amortized at 20% per annum at the reduced sink. So we have other plant with us as well. So I'm going to go in working for other plant over here. So cost, balance given, and this is 44,500. Less accumulated depreciation. So that's going to be plant 14,500. So carrying value at start, that's going to be 30,000. Depreciation charge for the year, and that is 20%. So this into 20% is going to be 6,000. So carrying value at year end is going to be 24,000 over here. So I'm going to put it like this. So I'm going to write depreciation plant working for 6,000. Other plant working for with 24,000. Right? Okay. Done. Now, moving ahead from here, let's see what do we have next. Point number 2. And the point number 2 states, on 15th August 2021, Keystone share price stood at 2.4 per share. On this date, Keystone paid a dividend included in the administrative expenses that was calculated to give a dividend yield of 4% over here. So we have a dividend yield over here. Look how, like, clever the examiner is. Rather than giving us the separate question for the ratio or something, or rather asking the separate ratio, he straight away checked that if we know about the ratios or not. So dividend yield is 4%. So we have the space over here. So I'm going to go over here now. That's going to be working 5 ordinary dividend paid. Okay. Now, the share price at the moment, 2.4. Dividend yield is 4%. Dividend per share is going to be 2.40 into 4%. Simple. So that is going to be 2.4 into 0.04 over here. 0.096 or 9.6 cents over here. All right. So that's going to be 9.6 cents over here. Okay. Now, this is the dividend 9.6 cents. So we have paid the dividend over here. So let's just go and calculate the total number of shares first. We have equity shares of 20 cents each at 50 million. So we'll write total number of shares in issue is 50 million divided by 0.2, and that's going to be 250,000 shares. Total dividend is going to be 250,000 shares into 9.6 cents. So that's going to be 0.096. That's 24 over here, right? So we are going to debit the retained earnings with 24,000 and we'll credit the administrative expenses with 24,000, right? So this is what we have to record. So I'm going to go over here, ordinary dividend paid, working 5, and from here I will minus this 24,000. Then I will write working 6, retained earnings. I will write that's going to be black and that's going to be highlighted. Then I'll write balance given at profit for the year less dividend paid working 5. So this 24,000 is going to be deducted from here. Okay, now the inventory at 30th September was valued at 56.6 million. This is the closing inventory that we have. So I'm gonna go over here in my inventory. 56.6 is 56,600 over here. I have no cost of sales over here, so I have to write the closing inventory over here as well. 56,600, right? So it will be deducted from here as well. Done? Okay. Then moving ahead. A provision for income tax. Finally, the tax point is over here. So I'm going to go in working 7. I will write tax. And this is the pet adjustment that you will have to do in every question. Okay. Then this is income tax. And this is deferred tax over here. A provision for income tax of 24.3 million is required. This is the current year balance. So closing balance is going to be 24,300. At 30th September, the tax base of the Keystone net assets was 15 million, less than their carrying amount. So closing balance, this is going to be 15 million into the tax base. So it's going to be 4,500. This excludes the revaluation effect over here. Okay, no worries, no worries. Now we're going to move ahead from here. So this is the 4,500 over here. Now let's just go over here into the trial balance. The deferred tax opening balance is 2,700. So I'm going to write opening balance 2,700 over here. Then I'll move up again. Let's see if we have anything for as far as the opening balance of the income tax is concerned. We don't have any balance. Okay, no problems. We'll go over here, opening balance nil, right? So I'm going to have the balancing figure over here, 24,300. I'm going to have a balancing figure of 4,500 minus 2,700 over here of 1,800, right? Now, overall speaking, I am going to have total balance of deferred tax. I have effect of tax base and carrying value, that is 4,500. Then effect of revaluation, that's going to be revaluation was 8 million into 30%, 2,400 So the total is going to be 6,900 over here. So this 24, this has to be now adjusted with the deferred tax over here. So I'm gonna go up over here. See, remember I told you that I am writing this as, I'm gonna minus this 2,400 from here. I have a total deferred tax of 6,900. I'll go here. I will write deferred tax working what? 7. The amount is 6,900. I will go over here. I will write income tax working 7. The closing balance is 24,300. I will go over here. Taxation expense working 7. Now 24,300 and 1,800. I'm going to add up these two. 24,300 plus 1,800. That's going to be 26,100 over here, right? Okay. So all of the points that I had over here have been solved. Now, let's just go at the start of the trial balance. Revenue, 377,600. Cost of sales are going to be from the working one. We'll have those later. Material done, production done, factory done. Distribution cost is 14,200. 14,200. Admin expenses, 46,400. We don't have any cost of sales opening balance. Then we have the finance cost of 350. I'll say the balance given 350. Then I have the investment income of 800 over here. I'll go over here. I will write investment income. This is going to be 800 and it's going to be added up over here. Property done, plant done, accumulated depreciation done. Inventory at first 2 by 28,000. 46,700 is the opening inventory. Okay. I'm gonna paste it here and I will write opening inventory over here. That is 46,700. Then I have trade receivables 31,150. Then I have trade payables 27,800. After that, I have the bank credit balance with 2,300. Then afterwards, I have the equity shares 50,000. So equity shares 50,000. Nothing with as far as the premium is concerned. And then the retained earnings, I have opening balance of 15,600. This one. Okay. Right? Right. And then I will have my closing balance over here for the retained earnings, right? Okay. Now, I'm going to go over here with my closing balances. And that's going to be 258,100. And then that's going to be 14,000. That's going to be 22,400 over here. So 258,100. Distribution is 14,200. Admin is 22,400. Okay, I'm going to go over here. Let's do the total for the gross profit. I get 119. Let's do the total over here. I get 35,800 and my operating profit is 83,700. Then my profit before tax is, and then my net Profit is 57,250 over here. Other comprehensive income, I have this revaluation reserve. This was working 3 with 8,000. So 8,000 is going to go less deferred tax working 7, 2,400 is deducted. So this is going to be with this 57,250 is profit for the year. So closing balance 48,850. This is working 6 over here. Reversion of 8,000 minus 2,400. Over here. Over here. Over here. Now, over here. Then the total of equity over here. And then total is going to be 165,750. $165,750, right? Okay, so this is what we have over here. Now, let's just pause for 2-3 minutes and we are going to resume with the second question. Okay, let's start the next question. This is the Quincy question. Again, by looking at the question, by looking at the trial balance, you are straight away going to scroll down and you are going to look at the requirement over here. And the requirement is to prepare a statement of profit and loss. And then you have to prepare a statement of financial position over here. So I'm going to go here. First thing first, I am going to create a format over here. Here we go. And then one over here. And this is going to be here we go. Quincy, statement of comprehensive income for the year ended 30th September 2022. Statement of financial position as at 30th September 20x2 over here. Now we are going to have the revenue, cost of sales with working one. Then we are going to have the gross profit. Then we are going to have the distribution costs, administrative expenses, leave one line, and then write operating profit. Then write finance cost, leave two lines, then write profit before tax, taxation expense, then we have net profit for the year. Then we have other comprehensive income. Then we have total comprehensive income for the year over here. And the net profit is going to be over here, right? And then underline this and then underline this over here. And then we'll do the rest later. Over here, we have the assets. After the assets, we are going to have the non-current assets. Leave 3-4 lines and then write current assets. We have inventory, receivables, bank. We have total assets. Then we have equity and liabilities. We have share capital, share premium, retained earnings, revaluation reserve. Then we have non-current liabilities. Leave 2-3 lines, then write current liabilities. Then over here write total equity and liabilities over here. So the question is going to end over here, here, and then some cosmetic formatting. Here we go. Then we're going to go into the workings. The working one is cost of sales, distribution cost and then admin expense. Then we have balance given. Then we have working to. On 1st October, 20x1, sorry, my bad. Okay. Quincy sold one of its product for 10 million included in the revenue in the trial balance. As a part of the sales agreement, Quincy is committed to the ongoing servicing of this product until the 30th September 20x4 over here. That is 3 years from the date of sale. The value of this service has been included in the selling price of the 10 million as well. The estimated cost for the Quincy of servicing is 600,000 per annum. And Quincy's normal gross profit margin of this type of servicing is 25%. The service performance obligation will be satisfied over time. Ignore discounting. Okay. Now, this is the servicing part over here. And, this has been included in total, basically according to the standard of the revenue as well. This shouldn't have been the case over here because technically speaking, this should have been deferred over here. So I'm going to go in the working to, I will write this as the deferred revenue over here. I will write total service cost per annum. And the total service cost per annum is basically 600 over here. Number of years are 3. Deferred number of years for which we have to do is 2. So 600 multiplied by 2, right? Into 100 by 75, because it says that the estimated cost is gonna be 600 over here, and basically the gross profit margin is 25% now. So this is just the 75%, so we have to gross it up over here. So we'll get the 1600 over here. This 1600 is going to be split between the current and non-current portion over here. That is 1600 by 2, that is 800 over here. So we will debit the revenue by 1600. We'll credit the deferred income in the non-current liability with 800, and we'll credit the deferred income in the current liability with 800 as well, right? So the revenue has to be reversed. So I'm going to go up revenue. I'm going to say this is 213,500 minus 1600 over here. Done. One thing. Secondly, I'll go in my non-current liabilities. I will write my deferred revenue. This is 800 over here. Then deferred revenue 800 over here, right? So that is how we have to record it up. Done? Okay. Now, point number 2. Quincy issued a 25 million 6% loan note on 1st October 20x1. Issue costs were 1 million, and these have been charged to the administrative expenses. The loan will be redeemed on 30th September 20x4 at a premium, which gives an effective interest rate of 8% over here. Now, the issue cost that was supposed to be deducted from the carrying value of the loan has been charged to the admin expenses. So we will have to reverse this, issue cost, which has been charged to the admin. We will have to reverse that as well. So if I go over here with the reference of working 3, I will say this is the loan notes over here. Now, first thing first, we have a balance given, the loan notes. The loan notes, where are the loan notes? 6% loan notes, 25,000. Less the issue cost. So we have the revised balance of 24 million over here. Number one. So we are going to debit the loan notes with 1,000. We'll credit the administrative expenses with 1,000. So one entry is this one, which we have to record. Now, we have number of years, liability at start, then we have the interest, then we have the total, then we have the repayment, and then we have the liability at year end over here. Now, we issued on 1st October 2021. So first year end is going to be September 20x2. Liability at start is going to be with the carrying value over here. That is the 24 million. Effective interest rate was 8% over here. So that's going to be into 8%. The total is going to be the sum of these two. Repayment. $25 million, 6%. So that's going to be 25 million, 6% is going to be the repayment. So I am going to have my liability at year end of 24420 over here. So this has to be recorded. This interest has to be recorded over here as well. And then we have to reverse the admin expenses. So I'm going to go up. I will write issue cost of loan notes. Working 3. 1,000 I will minus from here. I will go finance cost, loan notes interest. Working 3, amount is 1920. I'll go in the non-current liabilities, 8% loan notes, 24420. Working 3, 24420 over here. Right? All right. Now, after working 3, let's see what do we have next. Plant and equipment, yeah, this one. Plant and equipment is depreciated at 15% per annum using the reducing balance method. No depreciation has been charged for the year. All depreciation is charged to cost of sales. Working for plant and equipment. Cost, balance given. Plant and equipment, 83,700. Less accumulated depreciation. After the 83,700, we have to see the accumulated depreciation. Plant and equipment is 33,700. Carrying value at start is 50,000 over here. Depreciation charge for the year, 15%. Carrying value at year end 42,500. Lawn and equipment working for, yeah, 42,500 over here. Then depreciation plant working for 7,500 over here. Then the investments had a fair value 15.7 million over here as at 30th September 2022. There were no acquisition or disposal of these investments during the year. Okay. 15.7. So that's gonna be working 5 over here. Equity investments. Value at year end. 15,700. Less value at start. So what's the value in the balance sheet? Investment income, this is equity financial asset investments, 17,000. So we are going to have loss on investment over here, 1,300. I'm gonna go over here, loss on investment, 1,300. Equity investments, 15,700. Done? Okay. Then we're gonna go in working 6. The balance on the current tax represents the under provision. Okay, so we have a tax adjustment over here, 1, 2, 3, 4. Income tax and deferred tax. That's gonna be the closing balance. That's gonna be the closing balance. Okay. A provision for the income tax for the year required is 7,400. Quincy has a taxable temporary difference of 5 million, requiring a provision for deferred tax. So 5 million into 20% is going to be 1,000. Now going up, deferred tax 1,200. Current tax 1,100, debit balance on the debit side. So the balancing figure is going to be the sum of these two. Then the balancing figure is going to be 200 over here. So we'll have the income statement extract over here. We have income tax at 8,500 degrees and deferred tax 200, net charge 8,300. 8,300. 8,300 this is, and this is going to be working 6. Okay. Then we are going to have this deferred tax working 6, 1,000. Then we have income tax working 6 with 7,400 over here. Right? Okay. Then nothing else. Okay, now moving it from here, we got the revenue. Yes. Now we have the cost of sales of 136,800 over here. So 136,800 is my cost of sales. Distribution cost is 12,500. Admin expense is 19,000. Then I have loan note interest paid already accounted for. Dividend paid is 19,200. Okay. Let's go over here, working 7, retained earnings. Balance given and profit for the year less dividend paid. And dividend paid is 19,200. Then investment income is 400. Okay. Let's have this one over here. Investment income, I'm going to add up over here now. 400. Then equity shares 60,000. 6% loan notes done. Retained earnings. 6,500. This is working 7. After the retained earnings, plant and equipment done, accumulated depreciation done, equity financial done, inventory 24,800. Receivables 28,500. Bank 2,900. Current tax done, deferred tax done, trade payables. Trade payables 6,700, right? Okay. So I just have these teeny tiny adjustments over here this time. So I'm gonna have the total. So that's gonna be 144 and 18 and 12,500 over here. So 144, 300, 12,500 over here, 18,000 over here. Okay, nothing for the other comprehensive income. So this balance is going to be this balance over here. Now, 213,500 minus 1,600, and then 25,980 is my profit for the year. 25,980, and then my closing balance is 13,280. I'm going to put up the underlines over here, and then the sum here and then here. So 114 400, 114 400. Total assets is equal to total equity and liabilities over here, right? Okay, let's just have a break of 4 5 minutes or so. We're gonna come back and then we're gonna resume with another question. Let's have a break. Okay, let's start now this question. This is the clarion question over here. After preparing a draft statement of profit and loss for the year ended 30th September 2024 and adding the year's profit before any adjustment required by notes to 1 to 5 below to the retained earnings, the summarized trial balance of the Clarion is at 31st March is this one. Okay, so we have a suspense account over here as well. Then the following notes are relevant: 1, 2, 3, 4, 5, and then the requirement is to prepare a Clarion statement of financial position at 31st March and then prepare the extracts from the statement of cash flows. Okay. For the year ended 31st March 2025 with respect to the cash flows from investing and financing over here. Okay. So at the moment, I am going to focus on to as far as the financial position is concerned. I'm gonna go over here. I'm gonna go to this point, box it up, and then I am going to, this is the Clarion question statement of financial position as at 31st March 20x 5 over here. So we have assets, we have non-current assets. Leave like around 3-4 lines. We'll have the current assets, inventory, receivables. Then we have the bank. And then we have the total assets over here. Then we have equity and liabilities. This is going to be the share capital, share premium, retained earnings, revaluation reserve. We have non-current liabilities. We have current liabilities. We have total equity and liabilities over here. Right? Okay. Then we are going to have workings over here. Working one is going to be over here. And then we have the retained earnings over here at 31st March, which are given to us at 33,100. So technically we'll go into the working two of the retained earnings balance at year end 33,100 over here. Now let's start. On 31st March, 1/4 of the 8% loan notes were redeemed at par and 6 months outstanding loan note interest was paid. The suspense account represents the debit corresponding to the cash payment for the capital redemption and the outstanding interest over here. So what happened basically, you have repaid the part of the loan over here, the loan notes, they have been redeemed over here. So 8% loan notes, the total amount is 20 million over here. Let's see. These are the loan notes. Total value 20 million. Now 1/4 redeemed. That is 20,000 into 1/4 over here. So that's gonna be 5 million over here, right? Now 6 months loan notes, INTEREST, loan note interest paid. This is what we're gonna have over here. So 20,000 into 8% was the amount, now 8%, yeah, 8% loan note. So 20,000, 8% into 6 by 12 is what we are going to have over here. So 20,000 into 8% into 6 by 12, we get 800 over here. So the total amount is gonna be 5,800. Now we are going to debit the loan notes with 5,000. We are going to debit the interest, TEREST, interest expense with 800, and then we are going to credit the suspense account with 5,800, right? So this is what basically we have to do over here. So loan note interest paid is 800. I'm going to go over here. Loan notes interest paid, working one, 800 over here, right? Okay. And then it has been redeemed over here. So I will have 8% loan notes. The total value was 20,000, out of which 5,000 have been paid off. So that's going to be at 15,000 with the reference of working one as well, right? Okay. Now, moving ahead from here, we have property, plant, and equipment. Included in property, plant, and equipment is an item of plant with a cost of 14 million purchased on 1st April. However, the plant will cause environmental damage, which will have to be rectified when it is dismantled at the end of its 5-year life. So the present value, and discounting at 8% on 1st April 20x4 of the rectification is 4 million. Okay. The environmental provision has been correctly accounted for. However, no finance cost has yet been charged on the provision. And then no depreciation has been charged on the plant and equipment, which should have been charged, or which should be charged to the cost of sales on straight line basis over a 5-year life. No plant is more than 4 years old. Okay. So I'm going to go with the working 3 plant and equipment. Okay. So we have plants cost over here. Plant and equipment cost is 77,000. We have accumulated depreciation 19,000. After that, we are going to have the current year depreciation, and it's said for the current year depreciation, we have to divide it, or we have to depreciate it over the life of 5 years. 5 years straight line basis, right? So that's going to be 77,000 by 5 is going to be 15,400. So carrying value at year end is going to be the sum of 42,600. Then we have unwinding of discount. We have balance given of the provision 4 million. Yes, 4 million rectification cost. Unwinding is at 8%. Total is 4,320. So one is the depreciation charge, one is the unwinding, and one is the carrying value to year end, and then one is this amount as well. Now I'm gonna go over here. I'm gonna have the depreciation of the plant first. Depreciation of the plant that I have to take into account is going to be 15,400. Then we have the unwinding of discount at working 3, and the unwinding of discount is this 320. So I'll minus this over here. Then I'm going to go into my, non-current liabilities, future dismantling cost, working 3. And this is going to be 4320 here. 4320. And then I have the carrying value at 42,600 over here. So plant and equipment, working 3, 42,600 over here, right? Okay. Now, moving ahead, we have the next point, the right of use asset over here. The right of the use plant was acquired on 1st April 2024 under a 5-year lease with an initial deposit of 2.3 million and annual payment of 1.5 million on 31st March each year. The present value of the annual payments under the lease, excluding the initial deposit, at 1st April 2024 was 5.7 million. The lease has an implicit rate of interest of 10%, and the right of use plant has been correctly capitalized. The lease liability in the trial balance above represents the initial liability less the first annual payment over here. Okay. I'm going to go here working for this is going to be right of use asset over here. Now we have the assets cost. Okay. Let's see over here. Right of use asset 8 million. Depreciation charge for the year. Now, as far as the depreciation is concerned, we already have this hint over here that it has to be at 5 years. Because it was mentioned in the previous point that all assets are depreciated on the 5-year life, right? So we will have the carrying. Hold on for a second, please. Okay, so we are going to have the carrying value at year end 6,400. Okay, so I'm going to go up. Working for 1,600 directly from here, and then the right of use asset at 6,400. Right of use asset working for now. Let's just go for the liability half. And that's going to be number of years, liability at start, interest, total repayment, and then liability at year end. Now, first year end is going to be on 20x5 because this is 20x4, right? When you took, so liability at start was 5,700, right? So 5,700 is going to be over here. Interest is at 10%. So this into 10% is equal to the sum of these two. Repayment is 1.5 million. So liability at year end is this. Next year, same this one over here, 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 here. So non-current liability is 3,747. Current liability is 4,770 minus, okay, 4,770 minus 3,747. 1023, and this is going to be my finance cost over here. So I'm going to write interest on lease working for 570. I'm going to go in my non-current liability obligation under lease working for 3,747. Obligation under lease, and this is 1023, right? Okay. Then point number 4, investments through profit and loss are held at 31st March. They are carried at their fair value at 1st April. However, they had a fair value of 6.5 million on 31st March 2025. During the year, an investment which had a carrying amount of 1.4 million was sold for 1.6 million as well. Investment income in the trial balance includes the profit on the sale of the investment and the dividend received during the year as well. Okay. So now this is working 4. I'm going to go in working 5 over here, the parallel. This is going to be the fair value investment over here. Now, I have the value at year end, 6,500. Then I have the carrying value at start, 6,000. Gain on investment, 500, right? And then I have my investment income as well. Then their investment, which had a carrying amount of 1.4 million, was sold. And then I have investment income into trial balance. So investment income into trial balance 500. Okay, this is the investment income. Now I have to record this. I have to record this. I have to record this. So 6,500. I'm gonna write this as the equity investments working 5, and that's going to be at 6,500. Then I am going to have the investment income as 500, then gain on investment as well, and that's going to be of 500 as well, right? Okay, then a provision for the current tax. So I am gonna go in my working six income tax over here. And with this over here, a provision for the current tax of 3.5 million is required. And over here, we have the deferred taxes. So copy this, paste here. This is gonna be the income tax, deferred tax. So for the current year, 3.5 million is required. And over here is 12 million. Rate of tax is 25. Go up. Deferred tax 2,700. Right? So this is what we are going to have over here. And over here, the opening balance, nil. So we have this income statement charge of 3,500. Over here, we have a balancing figure of 300 over here. So income tax charge, I'm gonna minus 3,500. Deferred tax credit is 300. I'm gonna go over here. Deferred tax. Uh-oh. I'm supposed to have over here. Working six. Deferred tax is 3,000. I have income tax. Income tax is 3,500. Right? All right. So all the points done. Now let's just jump over here to the start and let's see what we have over here. So equity shares 35,000. Share capital 35,000. Why do I have it over here? Okay, now done. Equity shares 35,000 done. Then we have the retained earnings 33,100 already done over here. Then we have 8% loan notes. 8% loan notes done. Then we have the plant done, right of use done, accumulated done, investments done, inventory 11,700. Receivables 20,500. Bank 1,900. So bank over drop 1,900. Deferred tax and trade payables 9,400. After that, environmental provision done, lease liability done, loan note interest done, loan note interest, loan note interest. We have accounted for. Suspense account done, investment income done. So now I am going to make up the closing balance at the year end. So this is going to be 12,210 over here, right? Okay. Now I'm going to go over here, sum this up. Sum this up. Then sum this up. You get 87,700 over here. Retained earning working one 12 to 10 over here. Now, let's just cross check again if we haven't missed, because this is something, the reconciliation is, so we got this 33,100 over here. We had the loan note interest over here. We had the depreciation over here. Then we had, okay, here we go. Loan note interest paid is what we had over here. No, this is loan note interest paid, cash paid. Ah, for the redemption of the outstanding interest. Loan notes, interest, cash paid. This is going to be deducted as well. So this has to be deducted as well over here, right? Okay. Then deferred tax should have a balance over here. So deferred tax should be deducted. Here we go. $87,700. Okay, so this is what we have over here, right? Okay. So this is what we have overall speaking as far as what the final accounts is concerned. I'm going to pause over here. Next time when we are going to meet, we are going to start with as far as the cash flows are concerned, along with the ratios are concerned, and then we'll move forward, right? So the tip, just go through the questions again, do the practice again. If you come across any problem or something, feel free to ask me. I'll be more than happy to assist you and guide you in this, right? So now I am going to see you on the next class, that is on next Tuesday, right? So till then, take care of yourself, your family, friends, and the people around you, and have a lovely weekend ahead of you as well. Until we meet again, take care. Bye bye.